Just one more stock before we open is Paytm, right? That stock in pre-opening is down 6%. Reports indicating that the Enforcement Directorate is now entering the whole discussion to look for any breaches in security, etc. for Paytm. So all of that has made the street very nervous. So keep an eye out.
And ED largely operates under the framework of the prevention of money laundering.
Yes.
I mean, that's essentially their ambit. So that's essentially what this refers to. In a way, the last thing that Paytm needed.
And Nimesh had pointed out on the editors roundtable, right? Once trouble starts with some companies, you'll think that maybe you'll get that kind of bounce. We have seen it in the past with DHFL, with Yes Bank. Not saying that it's going to happen to this one as well. But once a regulator comes in there and pulls you up, in more often than not, it's not ended very, very well. And it's proving right, at least for Paytm, at least till now.
Absolutely. But let's just quickly kickstart things with the first trades on your screen now. The market open at 21,565 to start the day. And I think you got the Sensex, which is also sharply down, 180 now. So it's a deep down gash, so as to speak. The Sensex at 70,950, that's a 600-point cut, which is coming through. And I think you've got the Nifty Bank on your screen, which is around about 400 points. So yesterday, the Nifty Bank went up 1.5. It's given up 0.75% of that move with this lower start this morning. Sonia has walked across to the wall with more rates. Sonia.
Oh, thanks a lot for that. So, it's a very weak start that we have for the markets. In fact, the Nifty now down almost 176 points, not looking good at all. And if you look at a couple of these other spaces, right, the Nifty Bank is the one where you're seeing the maximum amount of pressure, down almost about 1%. But straight to result reactions, Nalco was the first one that you saw on your screen. Q3 EBITDA and margins above estimates, so the street likes that, bucking the trend over there. Z Entertainment, on the other hand, the numbers have been weak, the revenues are down, the margins are under pressure. Z Entertainment is straight off the back down about 4.5%. Wipro is in focus. The company has acquired 60% stake in Agne for $66 million. So Wipro is down almost about 2%. And then you have Sula Vineyards, where there has been moderation in the earnings growth this time around. And the street doesn't like that. Barely a 7% growth on the top line is what the company has seen this quarter around. Some more stocks that are in the news. There's BEL, where there's a huge order that the company has won to the tune of 2,167 crores. This order comes in from the Indian Navy. And I think the street would like IRCTC's numbers. It has been one of the darlings of the market in the last couple of years. IRCTC, strong performance, revenue growth of 22%. Festive season aided the earnings this time as well. Now, Gujarat Gas is one of the big accidents in the broader markets. 8% lower on Gujarat Gas this morning because it's a weak quarter. Citi has a sell with a target price of 425 on Gujarat Gas, so not looking good at all over there. 8% knockdown. And Bosch, as I was telling you, the commentary from the management is weak. The guidance is on the weaker side. So Bosch is down almost about 1.5%. But my worry really is about the overall market and the kind of selling pressure that we're seeing, especially in spaces like the Bank Nifty, which is now down about 500 odd points. Would also be helpful to take a look at Paytm and how it's performing, because now the Enforcement Directorate could be getting into the situation and looking for any kind of payment breaches, security breaches, etc. So Paytm, another huge knockdown of almost 10% on that stock. It's not looking good at all. As a couple of regulators now enter the fray. So overall for the market, folks, down almost about 1%, hanging on to the 21,600 mark thereabout. Let's see, it's not a good start, but let's see how the rest of the day shapes up.
Well, that's right, Sonia. Let's run you through some stocks on the broader market so that are underperforming big time. Anthony Waste, the stock is down close to 10% as we speak, so big selling out there. Genus Power, well, they've gone ahead and announced a capacity expansion, so the longer term story is looking up as we move to smart meters. But in the near term, it appears the street was anticipating more coming in from their numbers. And that's why, in fact, that stock as well is down closer to around 10%. MTAR Tech, well, out there as well, the stock is down closer to 9.5 to 10%. In pre-open, I recall, the stock was under big pressure with high volumes. RCF as well as Cosmo First, both of them, I think, post numbers. Both of them are under big pressure. On the flip side, you have a few stocks that are doing well. Nalco continues to build on to the gains, as we mentioned earlier today. Well, that's moved into the F&O band, so that's one stock that's moved up, and the numbers as well looked quite good. So that's up and about in today's trading session. NBCC, high volume, stock up 5%. SJVN up close to around 4%. It's bounced back. Remember, it's still down close to around 20% for the week itself. And Paytm, now it's gone down to around 340 rupees odd. So massive volumes out there. Z as well as lower, and Suzlon as well. So quite a bit of movement, but the Nifty, in the time that we're doing this market check, well, it's recovered a little bit, now on the verge of getting past the 21,600 mark.
Absolutely. And, Nigel, the open was just almost at yesterday's low, which is, the first level, which hopefully it'll hold. We didn't sort of cross that on the downside. Fell 10 points short of hitting that level. That is 21,543. The low today is 21,553. So exactly 10 points short of yesterday's low. And then there has been a bit of a bounce. So maybe we'll see. But that's what things are indicating. Beyond this, about 21,472, etc., come into focus, which is again not very far away. But that's the 40-day exponential, which will be in focus. Now, a few other names on the downside. Market breadth is negative, by the way. 3:1 in favor of declines is what you have, right? MTAR Tech, I think we mentioned, a full 10% lower on, some very large volumes. It doesn't show up on the top volume traded list, but look at that. 230,000 shares on the NSE. There is RCF, which is down 5.5. Gujarat Gas, Sonal was talking about, 6.5 lower. There is Prestige, which is down 5%, 1,084 on that one. Genus is down 10, a full 10, by the way. And you've got Lao Pala down about 5%. Volumes, then, if I go down the list, volumes are a little low at this point in the day. Irida is down about 5%. There's something like a Visakha Industries, which is down 5.5%. But then, so maybe come back to this list, because then you'll be talking about large price moves, but not backed by volumes, which I don't want to do. On the upside, SJVN is the number one volume-led gainer, 3.5 higher. It's followed by Nalco, which is up 3%, 146 on Nalco. And there is BPCL, which is up 1.6. That block got done, at least a portion of the block got done. NBCC, we highlighted the numbers, 5% higher. And you've got Adani Green, which is up about 2.5% as well. Indus Tower is at about 214. It's up about 2.33% higher. Novama is another one we should put up. It's 5% in the green. It's got volumes in it. New India Assurance, 3%. And Taj GVK saw a $50 move in the last last one hour from 2:30 to 3:30. It saw a very large, sharp high move, 15% higher at close yesterday. It's starting about 3% up once again. LG Equipment, 5%. ENIL has got a 15% move. And I could go on with some more names, but that's essentially the bulk of what you have. As I said, more down than up. But, the thing to note is that what is up on much larger volumes as compared to what is down, where volumes are, relatively speaking, a little bit lacking. So, important point there. 160 lower on the Nifty, 21,586 is where we find ourselves at. Devina Mehra is now joining us. She's founder, chairperson, and managing director at First Global. Devina, great to have you with us here. Good morning. Thanks very much for being with us here on CNBC-TV18. Prashant this side. Just map out, the markets for us. What we've seen so far, which has been unrelenting rally. And sort of intermittent. January, we saw a very short-lived small pullback. Day before yesterday, we saw a bit of a sell-off. Yesterday, of course, was much more orderly. What from here in the near and medium term to your mind, Devina?
Good morning, Prashant, and good morning to your viewers as well. So there is, little point in projecting short-term moves, but I will tell you, which is something I've been saying for the last month or so, that our view is that there is no risk of a huge crash, at least in the mainstream large cap, that kind of segment, because, as I've often repeated, that you had a very long phase of under trend returns in 2010 to 20, and you're still far below the trend line. So the real risk of a crash is when you're far above the trend line in terms of returns and so on. So that you're not there anywhere close to that. So that was one part. But also, when markets move that fast, there is always a risk of a sideways correction of some the past month or so, that we have been more than half hedged. I think right now we might be 75% hedged on our portfolio. So that is the way we like to play a market like this, where in the short term you might expect a correction. So just be hedged so that if there is a sharper correction than you expected, you are hedged. But on the other hand, since our view is that that there is no big risk in the medium term, we don't want to be out of the market and miss out on a possible up move. So that therefore you don't make a cash call, you just do hedge. So that's the thing we've done. And of course, you have to be careful And I've been again saying this, avoid the high risk areas of the market, which is the micro cap, small cap, IPO, that sort of thing. Within sectors also be careful. Of course, part of the correction has come, but, banking is still something among the major sectors that I would say be careful of.
Okay, well, be careful of the market. Look at it now. The Sensex is down 600 points. The Nifty is down 160 points and huge cracks in individual stocks. Devina, hi, good morning. I remember we did a Smart Money show about a month ago, right, where we spoke about how, whenever the Indian markets don't do well, global markets are in sort of a bull run, and it's good to sort of hedge yourselves and increase exposure to global markets. Do you think 2024 could be that year where global or other emerging markets perform better than India? And if yes, what should the best strategy be for an investor now?
So now, global diversification is not something that you should do with a one-year view. That I have always said the same, that it does not matter what the global markets did or what India did in the past 1 year or even what is expected in the next 1 year. Over a period of time, you should have build up to maybe 30% of your assets in global markets. I mean, just to give you one example, when I started working, the dollar was 12 rupees, and now it is 83 or thereabouts. And so there's an 85% depreciation in the course of a career. So when you're talking long-term goals, long-term financial planning, you cannot ignore global markets. Coming back to where India is vis-a-vis global equities, we still think India will outperform. In fact, we are overweight India in our global portfolios. But as I said, that's not the decision to make, that will India outperform in 1 year or not, and therefore decide whether to be in global equities or not.
All right. Hi, Devina. Nigel on this side. Good to speak to you as always. Devina, I wanted to ask you about what's going on with Paytm. I mean, do you have a view out there? The stock, in the unlisted market had so much of demand. Then it came out with an IPO of more than 2,000 rupees. Currently, the stock is at 350 rupees. What's your view out there?
Nigel, I have not. We've never really had a full-scale view on Paytm. As I said, our philosophy in managing money is to remember that investing is a loser's game. So the one who doesn't lose wins. The recent analysis of mutual funds also showed the same thing, that the mutual funds that outperform in the drawdowns or when the market goes down are the ones that are top of the list. And you can outperform in an up move even 93% of the time and still be almost the bottom scheme in your category. So coming back to Paytm, I mean, as I said, we've never bought it and we have never studied, because it has many businesses, and we've never studied it in that much depth. Of course, at the IPO time, I clearly thought it was overpriced. I was asked that question. And not just that, I mean, that whole slew of so-called new age IPOs that came out in 2021, I was asked that, gun to your head, which one would you buy? And I said, I don't think any of them was worth buying. Then I said, there are enough opportunities in the market, so no need to go on the high risk end. But I don't really have a view on the stock in particular.
I think you had a view on Tata Motors. I think you all were pretty much, I think you all were bullish on auto stocks, if I'm not mistaken, Tata Motors early on?
Yes. We've been overweight autos and auto components since the beginning of 2023, so a little over a year now. So overall, we've been positive, and yes, I mean, Tata Motors also we were positive, and that's been a good sector for us. So about in that time frame, we went overweight auto components and pharma, a few construction companies. So those have all worked out well.
Devina, just to sort of come back to that point which you were talking about earlier, global diversification, right?
Right.
Now, area to diversify into typically has been, of course, I mean, the US, right? Many funds, etc., have done that. But we got a very large market, which is China, which is completely bombed out now. And at the margin, do you think it's maybe, I mean, when you think about global diversification, that market should be part of one's thinking? What can one do? What's your view?
So, I mean, global diversification, one thing also which I keep repeating, that global diversification doesn't mean that you buy a Nasdaq ETF or a S&P ETF and you're done with global diversification. That is not global diversification because leadership always changes. No theme runs forever, whether it is geography, whether it's asset class, whether within a market it is the sector. So or a style, value versus growth, etc. So that always changes. So you cannot be locked into a fixed allocation of that kind in terms of geographies. 2003 to 7 was a good example when emerging markets went up 3.5, 4 times, and India went up 6, 7 times, Brazil went up 10 times. And during that whole period, even though US was already at lows after the tech crash, it just struggled and could not come up. And that's when, the stories get built that US is yesterday's story and the next century belongs to India and China and BRICS is coined. So don't get carried away with narratives. And you mentioned China. I mean, I would also like to point out that China market made its high in 2007. And the economy is now 6, 7 times what it was in 2007. And still the market is where it is. So there's also often a disconnect between the two things. So coming back to where China is today, we've actually been watching that when the signal comes that now the market will do well. And definitely it's somewhere in the range where it should the prospects should look better, but the final signals I don't think have come. Like last year, we were watching Japan for a few months and we wait for a little bit of confirmation. So we went overweight Japan, I think in April or May. And so that had a good run. So China, we're watching from that point of view. One more thing I would say that even if the Chinese market starts to look good, people only know those 2, 3 stocks, the Alibabas and so on. So when you buy China, doesn't mean that those are the stocks to buy necessarily. In fact, those are the stocks we normally avoid just because of the unknown risk of what the government would do. So you have to have granular data. So we look at actually 20,000 plus actual securities stocks around the world, and we make choices from that. It's not very just like buy China, and so I'll go and buy.
And how many out of the 20,000 in China, Devina?
I would not know the number, but China has a number of stocks is quite high.
Okay. No, I mean, the last 2 weeks, 3 weeks or so, for example, I met someone yesterday who said that they're launching a structure for China, an Indian fund manager based out of the gift city. So the interest certainly is coming back. For a retail investor, the best way to do it is through mutual funds, right? I mean, in terms of a structure. If they want to.
Actually, I mean, because this is a cause for me and there is little expertise, I mean, really speaking in India for that. So you're just paying for one extra layer of cost into a fund of funds or feeder funds. We have a global, actually multi-asset, multi-geography global structure that starts at $10,000. That's, about less than 8.5 lakh rupees. And let me tell you, that kind of structure is not available for less than $1 million. Because as I said, the leadership changes. So you just get into a feeder fund, into a US fund or something like that. That doesn't work. You don't want to be, for example, even if you buy China, you don't want to be locked into China for all times to come. So there were these greater China funds not too long back, I think in 21 itself. So, that's not the way to do it, because as an investor, how do you know that this is the time to be in the US, this is the time to be in Europe, this is the time to be in China? So it's better to have someone who understands this, that there has to be tactical and dynamic reallocation. So that's why this is a cause for me. So that's why we started with such a low entry point, so that let people start.
Got it, Devina. We appreciate your time here. Thank you so much for speaking to CNBC-TV18. Hope to chat with you again very soon. Well, the market is not looking good at all. In fact, the Nifty is now down 200 points. The Sensex is down over 700 points. And the Bank Nifty is under intense pressure, down 600 points. The top losers this morning are IT names. Wipro, Infosys, Tech Mahindra, LTI, Mindtree, all down about 2 to 3%. So not a good start to trade. But at the 23rd Global Conference of Actuaries, my colleague US Jan caught up with Amit Jhingran, who is the MD and CEO of SBI Life Insurance. Do note this is his first interview after taking over as the MD and CEO. Yash began the conversation by asking him on the issues that the insurance industry is facing around margin contraction and premium growth, and if these issues will continue. Listen in.
if you look at our figures and if you look at the industry figures for last 3 to 5 years, you will see that the SBI Life is consistently growing above the industry average, whether it is 3 years CAGR or 5 years CAGR. And we continue to do this in the first 9 months also.
Correct.
The results of first 9 months are as per the guidance provided by us at the end of Q1 and Q2. Despite increasing ULIP contribution in our product mix, it right now stands somewhere around 61%.
Correct.
Has not affected much as far as our margins are concerned, because SBI Life is the lowest OPEX operational cost company in the industry. So some of this ULIP products also, within the interplay of premium paying terms and all, have maintained our margin in the Q3 also.
You, of course, started by talking about how you outperformed the industry in terms of whatever metric of CAGR you want to look at. Going forward, do you expect your things like your low OPEX, your strong distribution to continue to help you to outperform the industry on premium growth as well as margins?
So, as far as Q4 is concerned, if you consider industry figure and the SBI Life figures for the last quarter, you will see that we didn't have that very high kind of tax adjustment effect last year also.
Correct.
So with that lower base, we are very sure that we will show the consistent growth in Q4 also, and the growth rate will be much better than the industry, which will also have a base effect of large March sale in last financial year.
You've cued me to my next question, sir. We've seen the January numbers for SBI Life. They look strong. What is your expectation out of February and March? And as far as Q4 is concerned, you spoke about it, you'll have a very strong base because of the rush of savings policies which we saw last year. Do you still expect positive APE growth in Q4?
Our Q4 last year was not as strong.
Correct.
Because our ticket size is smaller, we didn't get the advantage of that 5
larger
lakh
savings policies.
Larger saving policies in the last financial year. So we had a normal Q4 last year, and with the consistent growth figure, you already talked about the January, and you have seen our growth numbers, say around 15% in January month also, which usually is a lean month for SBI Life, but we maintained a 15% in January also, and I am sure that going forward, February and March will also be on the same trajectory.
So about 15% for Q4 is
plus,
what you're expecting?
Yeah,
okay.
15% plus.
Okay. What kind of shift do you expect further from the current point in your product portfolio towards ULIP? And then do you still expect to maintain margins around that 27.5%? Is that sort of the understanding at the company level?
So, as far as product mix is concerned, we definitely want to sell some more of non-par and protection products, because protection is also need of the hour. And in the recent past, we have introduced 2 new products in the protection also for with the higher ticket size and all. And in the current quarter, in the future also, our focus on non-par and protection product will continue. As far as margin is concerned, you should not read too much into one quarter, 0.5% here or 100 basis points there. Our guidance for the future is being around the same 27-28 kind of percentage, and with our kind of cost structure, we are sure that we will be able to maintain that.
Okay. One question, you spoke about non-par book and protection book. As of now, out of your total product portfolio, what is the share of non-par and protection? And with the focus that you have, let's say by FY25, where do you see that share moving up?
So, as I already told you, 61% approximately is the ULIP book.
Correct.
So, remaining 39% is non-par and protection. Of course, non-par is more than protection there, and protection book is somewhere we would like to work more. So, going forward, say 13%, 14% protection product, and remaining non-par and par products, we'll continue to focus on that.
Okay. I want to understand a little in terms of absolute growth in 2 segments. One is protection and second one is annuity. If I speak about growth, not about share but about growth, then what kind of growth are you expecting in FY25 as far as both these 2 segments are concerned?
So, if you look at our 9-month number, our protection growth overall was good. However, within the protection also, the group product showed a larger growth, and individual protection premium was like flattish.
Correct.
We would like to work more upon the individual protection side and provide enough within the product mix of the product itself. And your other question was about?
In terms of annuity.
So annuity, you had seen that we grew at around 35%.
Yes.
And in Indian financial condition, in Indian economy, the importance of annuity, where enough social services are not there, social benefits are not there post superannuation. Annuity is something which we need to work upon, and we will continue to work upon. NPS within the annuity is one segment again which holds immense potential, and as NPS matures, the outflow into the annuities from NPS is going to zoom, and SBI Life is well positioned to take advantage of that.
What is the impact in terms of quantification that you see coming on your APE growth and margins because of surrender value?
So
if it comes in the way it has been proposed by the regulator.
So the draft guidelines are out, and there have been wide-ranging discussion amongst the industry and with the regulators also. Going forward, I am sure regulator will take care that the short-term as well as long-term buyers of the policies are taken care of in an optimum way, and also the industry's concerns are also taken care of. At this stage, I would not like to quantify the impact on SBI Life in particular, but being the lowest cost operator, I am sure that we will be able to manage our profitability in a much better way in coming times also.
The parliamentary committee report, it spoke about reducing GST on term insurance products, which is very important. Right now, the GST is about 18%. Before GST came into play, the taxes totally were about 15%. What is your view? What is SBI Life's view in terms of on an important product like term insurance protection? What is the ideal rate of GST?
No, see, I cannot comment on the ideal rate of GST, but you yourself have said that GST is a major cost component for term insurance, and term insurance being need of the customer in India particularly, where protection is very low. Any tinkering with GST rates on the lower side will definitely help push up sales, and I really welcome the suggestion from the parliamentary committee, and I hope it is implemented soon.
If I could take the liberty of just asking for a yes or no on this question, are you actively on the lookout for inorganic opportunity?
No, I will not comment on that right now.
Okay. If I could just add one question to it. There are, of course, reports which suggest that Bharti has spoken to SBI Life, that is for Bharti AXA Life Insurance. They've, of course, acquired the 100% company now. They want to exit the insurance business, and they are in discussions with SBI Life. It will be a good asset. Of course, they've been into the business. It will add to your value also. What are the conversations? Does the asset look interesting to you at this point of time? We're not going into where the discussions are, but does the asset look interesting to you?
See, discussions in the industry keep on happening, but I will not like to comment on any particular transaction at the moment.
Okay, that's the management of SBI Life, but don't lose sight of the market, because now things are getting pretty serious in terms of the individual stocks that are falling, right? The mid-cap index itself is down about 400 points, which is a 1% slide straight off the back. And from the frontliners, it is names like Infosys and Wipro which are topping the charts on the downside. But in the broader markets, a lot of the PSU names are now starting to come under pressure. So whether it's something like an MMTC, NHPC, Union Bank, Punjab National Bank, all down about 1 to 4% odd. Even some of the gainers like Zomato example are starting to see a bit of selling pressure. So not looking like a good start to trade at all. Let's take a quick break. More on the markets coming up. Ravi Jhakar of All Cargo Logistics will also be joining in for their Q3 earnings. Later, we'll connect with Sanjeev Singhal of Mazgaon Dock Shipbuilders to talk about their Q3 performance. Stay tuned. Welcome back. This is Corporate Radar on CNBC-TV18. Well, all cargo logistics was under pressure yesterday on the back of a weak Q3 performance. Their revenues have shrunk this time. Margins have contracted. Ravi Jakar, who is the Chief Strategy Officer at All Cargo Logistics, joins us now to talk about that. Mr. Jakar, thanks a lot for joining in. You know, I want to first start by asking you about the situation in Q4, because in Q3, your revenues were under a lot of pressure. How is the situation in Q4? What is the kind of volumes and realizations that you're expecting to see? And is there more pressure in store?
So thanks. It's a pleasure being on your show. As you would notice, over the previous few quarters, given the global trade environment, our performance has been seeing decline on the revenue and bottom line. However, we had mentioned last quarter that this is now bottoming out. And if you observe the performance sequentially quarter on quarter in the international supply chain business, it's been more or less a flat quarter. EBITDA perhaps has gone up about 8-9% compared to the previous quarter. So we believe that this has been a bottoming out. The global trade environment has come to a subdued range, and we do not see immediate uptick in the quarter four. And we maintain that we expect trade revival to happen in the second half of the year, because we are seeing that inflationary pressure is easing across Western Europe and other parts of the world. So on the back of interest rate cuts expected in the coming months, we expect consumer demand to revive, and that should lead to improved global trade in the second half of the year. Having said that, we also have been speaking about various cost initiatives on our side on the back of digitization, offshoring, and that has led to some good benefits, which would start to show up from the quarter of April itself. The quarter ending March would see some amount of savings, as you know, these cost reductions come with some degree of termination notices. We would also see a bit of severance cost, which will be a one-off cost. But the outcome of this would be a leaner, more efficient organization, which should be able to grow on the back of contained costs. So that should be visible from the quarter of April. And we expect the trade revival to happen in the second half of the year. But like I said, if you look sequentially, the decline has been arrested, and now it's been rather marginally up on the international supply chain business compared to previous quarter.
So can you put some numbers to that? You're sitting on a base of around 3,200 crores in terms of revenues. What do you expect in Q4, and what is the kind of minimum growth that you can do in FY25?
So I would say that Q4 is not likely to be much different structurally, because the global trade environment remains quite similar. In terms of profits, like I said, FY25 onwards, which is from April onwards, we should see sequential improvement quarter on quarter. I would not put a specific number to it, but I would say Q1 FY25, given the cost initiatives and revival in the trade demand to follow, should be better than the current quarter, and then it should be sequentially improving. That's what our expectation is.
Hi, Ravi. Good morning. Good to see you. When you said that there could be some severance cost in quarter four, could you quantify it?
I wouldn't put an exact number to it, but like I said, you know, whenever we look at certain cost reduction on the personnel side in some of the geographies, that comes with one-off severance costs as well as we settle the amounts. But that will be a one-off amount, which could be there. But the outcome would be a sustained cost reduction on the back of a more leaner organization. That's how I would put it. Okay. We'll share exact numbers when we have them, yeah.
All right, Ravi, you also announced that scheme, right? I mean, we have been chatting for the last couple of years or so, and, you know, you all recently announced that scheme. By when does it, totally take place? By when does it get completed? Point number one. And there'll be some synergy benefits as well. So have you quantified that?
Yeah, so indeed, like you said, you know, we've been talking about it for the last couple of years, and this is like the final step in restructuring now. As you know, the scheme has been approved by the board in the month of December. It's currently with the exchanges. We believe that by the end of this year, January 25, December 24, that's the broad timeline in which we expect the scheme to go through. As you know, the international supply chain would become an independent company. And the biggest advantage would come on the side of contract and express logistics, which is currently in different step-down subsidies, and that comes along. Contract logistics and express logistics both cater to the same customer segment, which is ideally looking for fulfillment logistics. So therefore, we will be in a position to provide more integrated solutions of warehousing and express distribution. And therefore, there should be two kind of synergies there. One, on the customer side, we believe there should be an opportunity to enhance revenue, as we could gain higher market share within the customers. So share of wallet should increase with some of the customers. And second, naturally, on the organization structure itself, as two businesses which are so synergized and congruent come together, we should be able to rationalize on the org structure as well. So that would allow us to have synergies on the cost side, as well as synergies on the revenue side.
Got it. For Gati, I wanted to understand the way forward, right? You have an aspiration to hit 3,000 crores of revenues by FY26. Are you on track to do that? And, what is the growth trajectory that we can expect up until then?
So there are, 2 or 3 key components to Gati's growth strategy. First is operating strategy, where we want to continue to invest in infrastructure and improve the operations. That part has largely been done. I would say we are currently much improved than what we were a year ago as a service provider and amongst the best in the industry today. The operating measures are all matrices are in the range of 90% or above. So operationally, we have expanded the hub capacity, which is now good enough to take care of future growth as well. So operationally, everything is going well. On the commercial side, we anticipate revenue growth on the back of volume expansion. Now, if you see over the last few quarters, we have seen expansion in volume. But perhaps the first piece of revenue coming in is more from the larger accounts, and therefore the yield mix has changed a bit, which has led to revenue being more flat while the volumes have expanded. Going forward, we believe that the mix should improve, and that should lead to increased revenues as well on the back of continuing to increase volumes. So commercially, things look okay on the volumes and should improve on the revenue side. And with operations being more streamlined, we have already invested in people. You would be aware we have also added a little bit more competence on the management side with some key executives joining the board as well, and joining the company as well, which should help us allow a faster expedited commercial growth. So on the operation side, things in place. Commercially, things should improve over the next coming quarters, and therefore I would say we are on track on the plans. There could be a delay of a couple of quarters here or there from the original plans. In terms of the revenue guidance shared by the management team, it is driven by a combination of things, and the Gati management team would share more details on that.
All right. Just one word on fundraising as well. You have a board now to raise 500 crores via either the equity or warrant issue. Any kind of timeline that you're looking at for fundraising at Gati?
We are evaluating options. The idea is, the companies have a little bit of leverage. I mean, as you know, All Cargo for the quarter reported ending December, we only have a net debt of about 200 crores. But as a group, we believe it will be good, particularly in the domestic business, to not have any leverage and have better, reserves for supporting growth. So we are evaluating options right now. No specific timelines that I would like to comment on at this point in time.
Okay, all right. Ravi, always good speaking to you. Thanks so much for joining in and giving us details with regard to how you see business shaping up. In the last couple of times you said, second half of the year, you hope that things will revive and things are bottoming out. So we'll hold you to that particular comment as well and wish you all the best. Well, with regard to the markets, I think things are not looking so bad, I think, because we were down closer on 200 points and we've recovered a little bit, but that's not the point. For a market that's down close to 200 points, 150, 200 points odd, the advanced decline ratio is almost 1:1. And I'll view that actually positively, because there is some bottom fishing that we're seeing. Yesterday as well, by the time we wound up, we had almost even Stevens. And that's the line that I'm talking about, celebrating Valentine's Day, coming closer to each other as we speak. That's heartening actually to see in all seriousness.
All you need is a heart there, right? That's the meeting point. But, even on the Nifty, Nigel, the point is, we've been holding at the opening levels. There was a brief moment when we were down 200 plus points quickly, and that 200 point downtick for that brief moment meant that we broke yesterday's low, but quickly we kind of came back to yesterday's low right around there for the bulk of what we've traded so far, which is not very long. This is still the initial 1 hour of trade, and now we've kind of moved up once again. So, as you said, this is not as bad, doesn't look as bad. 0.5%, a little over 0.5% cut is what the Nifty is at, looking at right now. The small cap index also maybe, because the broader market is what many been talking about, the small cap index is up 0.5% as we speak. So there's a sharp recovery which has come through on the small cap index. And there was only an initial opening tick. That first 10-minute candle is what took us to the day's low. And since then, it's an upward sloping, sharp rally that we've seen in that part of the market. Prakash Gaba is with us for a quick check on things. Prakash, what would you do your trades?
I think Nifty and Bank Nifty both up to me. Bank Nifty in particular shows that perhaps it can go up from here. So I think I would be slightly bullish on Bank Nifty. Nifty is still not clear. Bank Nifty looks okay to me. Stocks that I like too. I think I like Colgate. Yes, it can go up from here. It's trading at 2567. Target is around 2600. And stop I would have is around 2550. So Colgate looks good to me. Second stock that looks good to me is I think Havells India. Havells India has given a breakout, trading at 1377. Possible target is perhaps for today or tomorrow could be 1400 zones. I think it's heading there. Stop below 1370 on Havells India should be fine.
Okay, all right. Prakash, thanks a lot for joining in and giving us that quick view. By the way, just want to pull up two of these PSU metal stocks that I was tracking earlier today. Nalco, as I had mentioned in my morning chat, expected to be the stock of the day because the numbers look good. The stock is in the in the F&O band, and also it corrected close to 15% in the last few sessions. So that's moved to the high point of the day. But the mood check that you're getting on these PSU metal stocks is by looking at Hindustan Copper. Valuations are out of whack. They're at close to around 80 times odd. The stock opened up 5% lower, but that's got bought into. That's telling you the kind of sentiment on some of these PSU metal stocks. And obviously, copper demand is expected to go up as EVs as well, see an increased demand. So the stock has almost moved into the green after opening up the cut of around 5% odd. But let's talk about Mazagon Dock then. The numbers look quite good. Margins as well expanded big time. We have Mr. Sanjeev Singhal, the chairman and managing director of the company, who joins us on the show. Hi, Mr. Singhal. Good morning, and thanks so much for joining in. Always good to see you on our channel. Well, when you joined us the last time around, you were telling us that you're expecting growth to be in that vicinity of around 12 to around 15% for the year. Do you stick by that? For 9 months, you're in that vicinity of around 11-12%. So what's the guidance, growth guidance for this year? And how is FY25 shaping up, given that your order book is looking pretty good?
Yeah, we continue to maintain that the growth for the current year would be around 12 to 15%. So 15% is slightly on the higher side, which we are targeting. And going ahead for FY25, definitely there would be a growth. Putting the numbers right now would be slightly difficult. But yes, what we can say is that there has been a healthy addition to the order book. For the last couple of years, there was only decretion in the order book and no fresh orders were being added. For the current year, 23-24, I'm happy to share that we have added fresh orders worth almost more than 7,000 crores. So this is a pretty healthy addition, and we are also looking for further orders depending upon what time they materialize. So going ahead, we definitely see positive growth in terms of volume of production, in terms of revenues, and in terms of fresh orders also.
Okay, fresh orders of more than 7,000 crores is what you've added. Can you tell us about this contract with the Ministry of Defense? What is the latest on that? What is the order value that we're looking at?
With the Ministry of Defense, we have received 3 orders from the Coast Guard, one in October, one in December, and another one in January. So these are with respect to cadet training ship, the offshore patrol vessels, and the fast patrol vessels, various numbers. And in addition, we have also received one export order. And apart from this, last year, June, we had received an order for medium refit and life certification for one of the submarines. In addition, we have also received an order from ONGC, which is undersea pipeline replacement. So the cumulative value of all these orders is 7,000 crores plus. We are also looking for the additional submarines, 3 numbers for the Scorpion category. And this would take a bit of a time to materialize, but we are expecting within this year, this should also materialize. So this would be one large value order. Apart from the 6 submarines with the AIP fitted, for which the bids have already been submitted last year. So these are being technically evaluated. And I'm not very sure whether this will be finalized within financial year 25 or this would spill over to the next financial year.
Right. Mr. Singhal, good to have you with us here on CNBC-TV18. Sir, Prashant this side. And, we talk about numbers and all these sort of technical things, but sometimes seeing is believing, right? And I think in December, if I'm not mistaken, the defense minister, and we kind of reported on this back then, but I think this is the first time we're speaking to you since then. The defense minister commissioned, India's latest stealth-guided destroyer, IMFA, right? I think that was manufactured by you. So yes. Congratulations for that.
Thank you very much.
Just to kind of try, not trying to sort of pin you down to give us exact numbers, but in the ballpark, sir, for FY25, what kind of revenue growth should we expect? I remember when we used to speak about a year ago, growth rates were in the vicinity of 20%. and you were pretty confident of that. That's come off a little bit over the last 1 year or so. So just a broad sense of what we should expect, sir, from here.
If you remember, when we were discussing with respect to the growth rate of around 20%, in 22-23, the growth rate was 37%. So probably that has already taken care of the growth which we were expecting. So some of that was to flow in the financial year 24, which we already registered in FY23. So this definitely will be having a sobering effect for 24. Where we are expecting 12 to 15%. Going ahead also, I don't see a very significant change because this is a shipbuilding industry. It takes time. This is infrastructure and the project durations are significantly longer than normal process industries. So right now, I would not be able to see a growth beyond 12 to 15% for FY25 also. But as we move ahead, a clear picture would be emerging.
All right, Mr. Singhal, earlier you were guiding for, I think, 10 to 12%, then you upped that to 12 to 15%. Is it likely you end this year closer to 15%?
We are trying so.
Okay.
We are trying
all
so.
right. You're trying for that. Okay. Also, what about the margin outlook? For the past quarter, gross margins, they expanded quite a bit. I think gross margins came in at close to around 45%. That compared with around 35%. So there was a big expansion out there. What does it mean in terms of gross margin as well as EBITDA margins going ahead? Steady state, because it's been all over the place, high single digit, 20%. There have been various changes in the business itself. So if you could tell us, what is the range we should work with?
Difficult to pin down any numbers, but at the same time, I would like to clarify that whenever these projects we are able to deliver before time. If you look at the projects in the past, there have been substantial delays on various accounts, not necessarily on account of Mazagon Dock shipbuilders, because LDs have not been levied on us, so the onus does not lie on MDL. But at the same time, when the projects get delayed, it has a negative impact on the costs. Many of the costs are not reimbursed fully by the government or by the Navy. And similarly, if we are able to execute the projects ahead of schedule or in time, it has a very positive impact on the costs. So if we look at the 3 destroyers which we have delivered in last 3 years, one in October 21, then November 22, and again October 23, which was commissioned by Honorable Raksha Mantri in December on 26th of December. All these projects have been delivered either within the contractual time or before contractual time. The 3rd destroyer has been delivered almost 5 months before the contractual timelines. So when I am delivering a vessel of this magnitude, 5 months ahead of schedule, it has a very positive impact on the costs and resulting into higher profits as well. In addition, what I have been informing earlier also, with respect to the submarines, of which 5 we have delivered, the 6th one we are targeting for delivery this year. There has been a LD which was levied by the Indian Navy on account of the delay from the contractual dates. But on analysis, the onus of the delay has not been on MDL. And corresponding to this, we have received a couple of LDs back. We have already received 3 LDs reversed. And during this quarter also, we expect 1 more LD to be reversed. So these amounts for the 3rd quarter also, we received around 160 crores close to a cash refund of LD, which also has a positive impact on the profitability. But these are the items which are not a stock item or a regular item for each and every quarter. Our normal business margins continue to be at the level at which they were prior to these developments. Once the LDs are refunded, there will not be any further LD refund. At the same time, we are targeting for the 4th destroyer delivery also ahead of schedule, which we are targeting for the 2nd quarter of 25. Yes. So in case we are able to deliver within 2nd quarter, that also would be having a positive impact on the costs and profit as well.
Got it. Got it. All right, Mr. Singhal, always good hearing your thoughts. And I think as you speak, you're sounding quite optimistic about achieving the upper end of that band of 12 to 15%. The stock price as well has moved to the high point of the day. Looking forward to having a chat with you in the coming quarter as well. As we were having that chat with Mazagon Dock, we had 3 new listings that hit Dalal Street. You have Jana Small Finance Bank and Capital Small Finance Bank. Both of them have opened a little bit lower, while Rashi has opened actually higher. So you have a mixed listing today with regard to those companies. Both those 2 small finance banks under pressure, while Rashi has opened up with a gain of around 7%. For the time being, though, I think we'll slip into a short break. You come back, we'll discuss all the top stocks. Stay with us.
Well, one of the big stocks under pressure is Aurobindo Pharma. So just pull up that stock for you right now. Ekta's here to tell us what's happening over there. The stock is down 4%, Ekta.
Well, yes, it's been a rough ride for Aurobindo all the time. I mean, all the way back since their Eugia Pharma 3 plants started getting inspected, because it is one of their key plants when it comes to current production as well as key filings going forward. Now, the street was waiting for that Form 483 with the observations. Remember, this particular plant was inspected in the month of Jan and went up till the 2nd of Feb and was issued 9 observations. Now, these observations, according to everybody who's seen them, has indicated that it basically relates to aseptic processes and documentation. Now, I went through the Form 483. It's a 26-page long Form 483. We had 3 US FDA officers in fact inspect the plant for that period of time, and each and every observation has a lot of detail in terms of what exactly the US FDA had in terms of issues. Now, some were hygiene issues, some were documentation issues, and just based on what we are picking up from that, it could probably be a longer road ahead in terms of remediation. Now, just to give you a sense in terms of the impact of this particular facility, this Unit 3 contributes to 40% of Eugia's business, which is basically their specialty injectables arm. Now, the company had indicated that they will be responding to the US FDA by the 26th of Feb on these 9 observations. By way of caution, they have stopped manufacturing at this particular site at this point in time. They are expecting some lines of, where the drugs are produced to probably initiate in a few weeks, and maybe the remaining part of the lines to start in a month. So that's what they are indicating. They could see an impact of $20 million in Q4 due to the shutdown of Eugia 3. The company was in any case not expecting major approvals from this plant in FY25, FY26. That's one of the reasons why the stock had rallied on the day of results, despite the company saying all this on the call. Now, they are confident of achieving 20% margin targets. They are expecting Eugia's growth to probably be fueled by Revlimid generic, and they're expecting launches of around $35 to $40 million. 50% will come from Eugia, so estimate $20 million could be impacted. Now, the street is going to watch for what happens next. Is there a warning letter? Does the US FDA take the remediation on board? Is there an import alert? Now, remember, sterile or maybe plants such as these with these kind of observations is probably going to take a longer road in terms of remediation. We don't know the impact at the end of the day, whether it could be a warning letter, whether it could be a VAI, or whether it could be an import alert. If it is an import alert, which is the worst case scenario, it could have around 15% of impact on the consolidated EBITDA, according to PL. They have a buy right now, but they have said that you need to keep the fact that this adverse event could probably change estimates.
Okay, all right. That's a stock on the downside. Thanks a lot for that, Ekta. But as I mentioned earlier today, the stock on the upside was expected to be Nalco. It's moved into the F&O band. The stock had seen a bit of a correction ahead of its numbers, and the numbers look very, very good. On the top line, there was a beat. The EBITDA number, much better than what the street was working with. No one on the street even had a number closer to around 700 crores. They came in at around 770 crores. Margins in excess of around 20%. As we know, alumina and aluminium prices, they're driven by global supply-demand dynamics. But on the cost side is what they've saved. And that's why the street likes it. Power cost is being saved. Raw material cost as well has been saved. And on the EBIT front, sometimes you have alumina doing well, aluminium doesn't participate. But this time around, both have done well. In fact, on the alumina side of things, which is termed as the chemicals business, well, that's improved big time. On a sequential basis as well, that number has doubled. On a year-on-year basis, it's up nearly around 4 times. And the aluminium business as well looked very good, coming in nearly around 480 crores. The sweetener comes in because they've declared a bit of a dividend as well. So that's why the stock is up and about in today's trading session. Clearly, the stock of the day for me.
All right, well, let's do one thing. Let's take a quick break. On the other side, Lata will get chatting with the management of the latest debutant on the Dalal Street, Jana Small Finance Bank. Ajay Kanwal of Jana Small Finance Bank will be with us to talk about their listing. Stay tuned.
Welcome back. Let's talk about the latest debutant on Dalal Street, Jana Small Finance Bank. It has been a subdued listing for them, listing at 4% below the issue price of 414 rupees. They listed around 396. Okay, now at 397. And the fault doesn't lie with the demand for the stock. It was subscribed 18 times or oversubscribed 17 times. It's just the day that it is listing is a somber day because of happenings in the US. But joining us now to speak about the bank is Ajay Kanwal, Managing Director and Chief Executive Officer at Jana Small Finance Bank. Ajay, good morning and thank you very much. Congratulations on the listing, though it's a subdued one. What's your sense going forward in terms of the business? What are you all targeting in terms of deposit, loan growth and margins?
So a very good morning to you, Lata. And as you know, small finance banks were used to always going against the tide. So it's a somber start. We have used to, going against the tide and rising up. And that's been our journey so far. And see, from what do investors expect or what will the bank do? I just want to highlight a few things, Lata. 5.5 years since we converted from a microfinance institution to a small finance bank, we have moved towards a customer franchise, which has automatically taken the bank to a secured business. So we are roughly about 58% secured, which tells you that the book is much more resilient and much more customer focused rather than a product company. Second, our growth rate, if you take September growth rate on loan book, is about 40%. You take a liability growth rate, it's about 37%. So we have very strong growth rates. And one should expect strong growth rate for banks like us because clearly we are serving the underserved segment. So there is a lot of demand. Our
Ajay, what
most
is the
important parameter really is, sorry.
No, what is the credit deposit ratio at this point in time? I know that you all have just started on your liabilities move, but what is the credit deposit ratio right now?
Yes. So the CD ratio as of September 23, Lata, was at 110%. Okay. And I must say, given the growth in branches, the growth in RM, the launch of products, our ability to price deposits, we certainly see that being maintained at a much lower level as time passes. Okay.
And what about margins? I mean, while I know that you all have started on your journey on getting liabilities from your customers, what is the expectation in terms of cost of deposits? It's coming at a tough time. And therefore, what will be the trajectory of margins, you think?
So, Lata, our total deposit book is 19,000 crores.
Yeah.
And we have roughly about 5 lakh customers who are on the liability side. And like I mentioned, the growth rate is 38% year on year. Now, the cost of fund increase in between March to September has been 40 basis points on the deposit side. Okay. However, our net interest margin for the bank, which was at 7.7% in March, is at 7.8% in September. So thanks to the product mix on the asset side, we have made sure that the entire increase of cost of funds has been absorbed through our product mix change. Secondly, very importantly, we are 5.5-year-old as a bank, and really the trust factor, customer believing us, making sure that their AUM with us keeps growing, is a phenomenon we're seeing as time passes. So something we are very comfortable with, and we will certainly make sure our deposit rate far outpaces the asset growth. Okay.
No, as you pointed out, it is the nature of your asset which keeps your margins high. It is 42% unsecured. And of course, in that kind of business, unsecured business is likely to be high. But you have some troubled past in terms of the quality of assets. You have had a large write-off in both FY22 and FY23. Can you give us some guidance in terms of asset quality?
So, Lata, 2 times where we've really had asset quality issues have both been, times which had unprecedented large natural issues. So clearly COVID was the last one. So, but if you take March 20 numbers, our unsecured net NPA was below 1%. Okay. You take September 23 numbers, our unsecured net NPA is still below 1%. So I think we do struggle when things become really, what I should say, 1 in 25-year events. But if you take all the regular economics cycles or natural ways the country works, our collections are 99% plus. So I think just to get the quality of book right, one is only when it's really troubled, we get troubled. And certainly on the unsecured side. Now with 58% becoming secured, and we have done 58% in the last 5.5 years, it's been a secular move. And I'm sure we will continue going that way. I do think that even if a next crisis does come up, we are much more resilient than we were probably a few years back.
Okay. Are you planning to bring down your unsecured book? Are there any internal targets?
So there are no targets. See, Lata, we are moving in a very natural customer way. If you take a customer's balance sheet, the biggest loan product is actually the mortgage, right? Then the car loan, two-wheeler loan. Unlikely the customer's balance sheet has 70 to 80% unsecured. So as we move towards the customer, we will naturally get secured, and which is what we are seeing happening in the bank as we speak. So more than targets, it's about us making sure that we're meeting customer needs, and that automatically leads to, let's say, a two-wheeler loan, a four-wheeler loan, a gold loan. If he's got a property, a LAP. Even in MSME, we are doing supply chain, vendor finance. We are moving naturally towards secured. It is not an unnatural push. And obviously, the other very important part is the secured loans are longer-term loans. They run off very slowly. Unsecured loans are shorter 2-year loans. They run off very fast. So the book is also naturally building much faster in secured. Our secured growth rate from 21 to September 23 is about 40%.
Okay. No, I'm not holding it against you, given the nature of your clientele, and unsecured loan would perhaps be necessary. I'm not holding it against you. I'm just saying that, for a bank investor, one would want to know the safety of that loan. What about margins? You said 7, it's risen from 7.7 to 7.8. But you think this can improve, or given the cost of deposits, the pressure is downward? You're more likely to report closer to 7.5 in the coming quarter.
So, Lata, my sense post-budget and what we see around is, we're kind of plateaued in the cost of funds. We obviously saw a big rush for deposits and pricing of deposits in the last 1 year. But my sense is that given what we are doing and what I can see competition doing, we're plateaued out. So I do think NIMs will sustain from where we are. As we turn more secured, there could be a small drop in NIMs, which will easily be compensated back by a drop in cost of funds. Or of course, our cost of operation will also get better. Because as you know, secured businesses tend to be a lower cost income than unsecured businesses.
Yes. So you expect your cost to income and your credit costs to fall?
Yeah, so see, we are building a resilient model which is more secured. We have good NIMs because, see, we operate in affordable housing. So while I'm big in housing, my average ticket size for housing is 12 lakh rupees. So we tend to get better NIMs even though we do secured because we're doing small ticket size. I have a micro lab book. Ticket size is 9.5 lakh rupees. The yields are much better. So I think yield management is manageable by us. Market is good. We just need to make sure that we do good growth.
Okay, yes. I guess everything will depend on diligence. Ajay Kaval, thank you very much for joining us. Congratulations once again for becoming a listed stock.
Thank you, Lata.
And we will touch base with you every quarter.
Thank you.
Okay, so that's the listing of the day. Not the most propitious environment. And why is it not a propitious environment? It's because of what happened in the United States. The CPI inflation number for the month of January coming in higher than expected. The month-on-month increase has come in at 0.3. The expectation was it would be 0.2. The 12-month year-on-year full inflation was expected to come at 2.9. It's come at 3.1. Compared to, of course, 3.4 in December, it's better, but the expectation was it would be 2.9. The biggest culprit is home prices, shelter prices, which accounted for a 0.6% rise month-on-month and a 6% rise year-on-year. So that was the biggest component. What everyone would watch out for, including the Fed core CPI, that accelerated by 0.4%. Market was tolerant of 0.3. So even that's come in higher than expected. So the overall core inflation is still up 3.9% year-on-year. The expectation was 3.7, would have been acceptable. Now, what's immediately happened is all bets for a rate cut in March and May have moved back. May was still an expectation of 64%. Now the May rate cut falls to 36%. So clearly, the market has moved to June as the first rate cut. And more importantly, there were 6 rate cuts priced in calendar 24. It immediately has fallen to 3 rate cuts, which aligns itself with the dot plot of the Fed. The impact on the yields we've already seen. We saw the 10-year shoot up to 4.32, but the impact was also on the dollar. Dollar index at one point in time on 12th February, that is yesterday, for the United States, it was at 104. It leaped to 105 almost, 104.881, thereabouts. Now, what we will look forward to, this could be a one-day disappointment for the market because the US PPI number, Producer Price Index number, is due on Friday. And the PPI goes into the creation of the PCE, Personal Consumption Expenditure Index, which comes out on Jan 29th. Now, the CPI component in the personal consumption expenditure is what the Fed looks at. It doesn't look at the CPI. So, actually, this could be a one-day disappointment for the market. And if the PPI numbers were not as bad, then we could see the markets even bounce back. Impact on India itself, the 10-year bond yield has gone up to 7.14. With this, whatever gains we made because of the budget borrowing program being much lower than expected has been wiped out. We had fallen to 7.05 because of that. Now we are back to 7.1413 as I speak because of the expectation that as the Fed moves out, the RBI rate cut also moves out. Rupee hasn't weakened much from 83 to 83.10. It's not a great deal. That, of course, is, there's also the crude impact today. Crude's also higher as is the dollar. But this could be passing since the rupee is usually strong in the Jan, Feb, March quarter. There are lots of exporter inflows. And from June, we are expecting the bond inflow. So not much impact on the rupee. Clearly, the biggest casualty in the Indian market are the equity markets, as we've already seen. Because as US bonds become attractive, it's a risk-free return of 4.3 that you are getting. You are bound to see outflows from EMs and India. So that's what we are seeing just for the moment. But I think the overall positive should not be missed. The US economy is very strong. That means a stronger than expected world economy, and that can be only good for equities ultimately. Wrap up on Bazaar on that note. Chart Busters coming.